Let's kick off this morning with June Go, Senior Oil Analyst at Sparta Commodities in Singapore. June, I wanted to start by getting your thoughts on why we've seen a collapse in the spread between WTI and Brent. It's only a few trading sessions ago that was as wide as $15, and now we're down to $1.50.
Good morning, everyone. So I think WTI Brent, which is what we've typically monitored in the market, has been uh, much wider than what fundamentals would have asked for. The minus 13 to minus $20 per barrel did not justify the levels that it should be, because from a logistics point of view, the ARB is basically looked at versus TD25, which refers to the freight econs to bring an EFRA of WTI into Europe. And that number was it's not minus $13 per barrel. So right now it does seem like it's overdone to the minus 150. Probably a more comfortable level or more reasonable number would be like the minus $4, minus $5 per barrel in terms of logistics. And probably it's also the psychology where WTI right now it seems to be more supported. We are seeing more oil flows going out from the US into many other regions, including apparently one cargo going to Greece for the first time in 4 years, showing that people are looking for WTI, and it's going to be therefore higher value than before.
Looking at the situation in Asia again, June, looking at China, the oil price has held reasonably. I mean, $100 is certainly a big number. When a month or so ago it was a lot less, and we were Brent and WTI in the 60s. Where does China sit right now? We saw them emerge out of the sort of quiet yesterday, joining Pakistan in signing on to a 5-point ceasefire plan. Is there any incentive for China to get directly involved here? Is there concern from the fact that obviously, as Donald Trump said yesterday, and he's right on this point, technically America doesn't need the Strait of Hormuz for its energy supply. China desperately does. Is China elevated, animated to try and participate in a solution here because it does rely so heavily on Gulf oil and gas?
Most definitely, China has a huge exposure to the oil coming out from Strait of Hormuz. There are arguments that they are very good friends with Iran, so they do have oil. But the quantities that they are getting from the other regions like Saudi is way more than what Iran is currently providing. So they will need to, in the long run, to get the oil coming out from the Strait of Hormuz again. So the participation right now seems to be not in the war mode. Like, I'm not going to be putting ships or troops on the ground to support this initiative to reopen. I think they will go more the diplomacy route, and they will definitely want this to resolve as quickly as they can. Having said that, just a few months ago, we were talking about the huge stockpiles of SPR that China has. They have not tapped on it yet, even today. Compared to like China, Japan and South Korea, which are part of the IEA, they have already released their barrels, but China has not taken their own SPR. And I think they are therefore still very well positioned to.
So what, they're buying in the open market every day? They're still importing 12 million barrels of oil a day and meeting consumption needs, paying these big prices? China typically doesn't like to spend this kind of money.
They have actually reduced their run rates. Right, they very, very early from the start, probably the first week of the conflict, they announced a product export ban. So they don't have to run up to overseas export consumption. They only run to domestic consumption. And just recently, we heard some reports that they are selling a few small little cargoes, supporting Philippines and Vietnam in diesel. But other than that, they have reduced run rates both from the state-owned enterprise run refiners and also the teapot refineries. So overall run rates have come off in China as a current measure to reduce crude oil consumption.
But how does that what impact has that had across Asia? I mean, in the products market tightening that significantly, and yet it seems Asian manufacturers are holding up.
I don't agree that the Asian manufacturers are holding up per se. We already saw the force majeure in many petrochemical players in our region. Again, like within the second week of the conflict, numerous in Chandra Strait in Indonesia, FPCC, and it's just uh, panic mode, I would say, in the downstream petrochemical sector in Asia. Um, so China not producing the rest of the diesel transport fuels in the market is obviously affecting down under. Australia is a big importer of all those oils from the Chinese market, and they are scrambling for oil. It is a difficult situation right now.
June, looking forward here, from the point of view of the sort of legacy and if indeed, I don't know, I'm being of April Fool myself, being looking through that we're near the end of this than the beginning. Maybe that's just wishful thinking on my part as we live in the middle of this all. But from the point of view of Asia, how critical is that an off ramp is found soon, or has the damage been done now, and it will just materialize as time goes on with inflation and shortages? Or what is at stake for Asia, June, if this continues?
I think we passed the point of no return by the second week of the closure for Asia. The reason why I say this is because at that point of time, we already start to see production shut in. So you have clear loss of barrels, and we are importing more than 80% of those barrels from the Straits of Hormuz. And the damage done for petrochemical sector is there. It was the first to shut down because number one, you have naphtha imports that cannot come from the Middle East, and number two, the domestic refineries in Asia cannot run up to produce the naphtha that they need in the petrochemical sector. In terms of the startup, then you need the flows to come back online into our markets. Just say when the Straits of Hormuz reopens tomorrow, you will need another 2-3 months before the flows renormalize from crude perspective, and then another 1 to 2 months later for the petrochemical sector to restart because of the steam cracker they need to start up again. So it's at least another 4-5 months before Asia can resume any sense of normalcy post the crisis. It's a painful startup.